everyone, welcome. We're going to give everyone just a minute to join and then we'll get started. I hope everyone's day is going well. Happy Tuesday. Thanks for joining us. Great. Well, we'll get started. I know everyone is probably antsy to learn more about direct indexing. So thank you so much for joining us today and welcome to our webinar. It's Beyond the Index, Unlocking Customization and Tax Efficiency in Investing. During this webinar, we're going to cover strategies for choosing investment vehicles and maximizing tax efficiency, an overview of direct indexing, what it is, how it works, and how investors leverage custom indexing. Just some reminders that we want to make sure that you know. You can use the Q&A function at the bottom of your screen just to ask any questions. Stu here is going to help us get them answered at the end. And just throughout, if you have any questions, feel free to pop them in the window. And then we're going to send this as a recording in the coming weeks so that you have access to it. Great. Well, I'm Ashley. I'm the head of client marketing here at Savvy, and I'm joined by Stewart Martin. Thank you, Stu, for joining us. I'm just going to tell you a little bit about Stu. Stu is a senior investment consultant at Orion, and he brings 24 years of experience in investment management to his role. At Orion, Stu plays a pivotal role in sharing the benefits of custom indexing. He's helping everyone understand how this innovative approach can enhance their investment portfolios and achieve their financial objectives. Thanks for joining us today.
Oh, thank you, Ashley. It's great to be here today. Welcome, everybody, to our call. Excited to be here talking to you from Sacramento, California, which is one of Orion's offices. As Ashley mentioned, I'm a senior investment consultant with Orion's custom indexing program. I work in a variety of roles within Orion, but some of my primary roles are working directly with clients to design portfolios that can create tax efficiency. Also working with clients that have large embedded capital gains in their portfolios to help them control risk. And then finally, help clients with direct indices design tax efficient solutions to be able to create transitions out of capital gain assets, high capital gain assets into more diversified portfolios. So today we're going to be talking about a variety of topics, looking to cover this in just about maybe 25 minutes and leave some time for questions. So the goal of the call today is just to really give you kind of a high-level overview of one of the tax-efficient tools that Savvy has within kind of the toolbox of investment vehicles and capabilities around managing taxable assets. So I'm going to talk a little bit about a survey that we did with investors across the country, and then dive into some comparisons of mutual funds, ETFs, and separately managed accounts, and just talk about the differences between those vehicles and how they can create tax efficiency. Dive into what is direct indexing, which is a really fast-growing area of the asset management business and can be very, very helpful for tax-sensitive investors. And then we're going to go into some custom indexing use cases and then wrap up with a few questions. So touching on a survey that we conducted with investors within the Orion system, just asked, what do investors want with their investment portfolios? And as you can see here, 90% of investors agree that taxes can eat away at their portfolio the same way volatility can. And when you look at most taxable investors in the marketplace, a little known fact regarding what we call tax drag is that most investors suffer from around 1 to 2% of average tax drag in their taxable investment portfolio, which is quite a large number when you think about, say, an equity return of roughly 8%. If you subtract 1 to 2% in tax drag and then say take another 1 to 2% in inflation and maybe another 1% in fees, you're looking at a real return for an equity portfolio of around 3%. So our seminar today is designed to talk about how we can return that 1 to 2% in tax drag to allow you to help grow your portfolio faster and also provide more longevity to your portfolio in the retirement years. 80% of investors want minimal tax obligations in investment portfolios. I know this is a shocker. I think all of us, when we think about taxes and capital gains that come from our investments, we all want lower tax obligations. And again, that's what our seminar is focused on today. And 90% of investors want expert support and resources. And direct indexing is a resource that you have available to you through Savvy to be able to create tax efficiency in your portfolios. So let's talk a little bit about what a direct index is. Direct indexing, as I mentioned, is one of the fastest growing areas of the asset management industry today. I have the good fortune of starting with one of the pioneers in the space. It's a firm called Active Index Advisors. It's owned by Natixis Investment Managers. Active Index Advisors started direct indexing back in '99. Not the first one to direct indexing, that was Parametric, which started roughly in 1994. But direct indexing is a really interesting kind of concept around the overall concept of indexing or creating passive portfolios that track an index. And direct indexing is really a byproduct of the evolution of investment vehicles, starting with mutual funds. Mutual funds started to become very popular in the 1930s and 1940s in our country. Mutual funds provided a lot of great capabilities to investors around being able to diversify amongst lots of different assets. You can do fixed income, you can do equities, stocks, and mutual funds have a lot of great things to offer to clients. But one big drawback, which anybody who's owned a mutual fund has seen this firsthand, that mutual funds can be quite tax inefficient. And there's a couple of different reasons for that. One of the primary reasons is they have to pay their capital gains at the end of every year, regardless of management of the portfolios. So oftentimes we receive large gains at inopportune times from our mutual funds. Also, typically mutual funds have been active in their approach and the portfolio turnover, and that activity of buying and selling securities by the manager in the attempt to outperform the market creates tax drag and creates a lot of tax inefficiency. And then third, within mutual funds, investor behavior can influence the manager's ability to create a tax efficient portfolio. So if you have lots of investors selling the mutual fund, that can force the manager to have to raise cash and sell investments and create capital gains even in down years, which can be particularly irritating when you have a mutual fund that's down and you still get a capital gain at the end of the year. Now you fast forward to the 1970s and Jack Bogle at Vanguard came up with the idea of creating an index mutual fund where instead of having an active manager focusing on just targeting a passive benchmark like the S&P 500, and then you move into the 90s and exchange traded funds took that same idea and put it in an exchange traded fund wrapper, which opened up additional tax efficient techniques and the ability to create tax efficiency for investors. So ETFs greatly enhanced what was going on in the investment industry as far as mutual funds. And then separately managed account and direct indices started to come on the scene. As I mentioned, Parametrics, a pioneer in the space in the mid to late 90s, with the idea of having an investor be able to design a index, but do it outside of a wrapper such as a mutual fund or ETF. And mutual funds and ETFs are what we call pooled investment vehicles. You share the cost basis with all the other investors in those vehicles. And the advent of direct indexing and separately managed accounts, the client actually owns the individual positions in their portfolio. So it's their own personalized index. And by owning the individual stocks, the Coca-Colas, the Johnson & Johnsons, say if you're replicating the S&P 500, that opens up all kinds of tax management techniques that ETFs and mutual funds do not have to be able to create tax efficiency in what we call tax alpha. So how this process works, say an investor comes to me, and as I mentioned, I'm a portfolio consultant. So a lot of my daily role is designing personalized indexes for investors. If you came to me and said, Stu, I'd like to create a direct index that targets the S&P 500, we would unwrap that index, which essentially means that we would target about 150 stocks, mainly the larger stocks within the index, to track the S&P 500. Next, we would customize the index according to your tax needs. If you're a highly tax-sensitive client, we can use techniques like tax loss harvesting, or if you have gain securities from, say, a previous financial relationship, you can actually put those securities into this portfolio and use those to fund your index. And then on an ongoing basis, that index will be professionally managed. And that's what the portfolio management team and our systems do on a day in and day out basis. And we actually look for our portfolio, in our portfolio, clients' portfolios, to tax manage their portfolio daily. So we're looking for opportunities every single day that the market is open to be able to say, okay, what can we do to help create a higher after-tax return for our clients? And we have roughly 10,000 accounts, and we can review those 10,000 accounts in just under an hour. So we do that every day. And then our portfolio managers provide some human oversight on top of that to make sure everything is tracking and functioning according to our processes. So as I mentioned, custom indexing, it's an evolution from indexing that typically uses index mutual funds or ETFs. And by having the capability to buy the individual securities and have those in your portfolio, you open up a whole host of capabilities around tax planning. So these are some of the activities that you can use these type of portfolios for. Tax transitioning and concentrated positions, I'm going to go through an example of that. Sale of a business, if you have a large gain event in the future and you're trying to generate some losses that you can bank to offset a large capital gain in the future, we can set up a direct index to design that use case. Automated tax loss harvesting, if you're charitably inclined and want to be doing charitable gifting in the future, this can be a very powerful vehicle to extract tax efficiency today. And then we are able to design gifting strategies where we use the securities that have created those losses and that tax efficiency to gift those securities in the future. Also, a high level of customization if you would like to use your portfolio to focus on any values-based investing or faith-based investing, because you own the individual securities, we have a high level of control around creating a customized portfolio. Okay, so those are the basics as far as the strategy. And what I find when I am doing education events or webinars, really the best way to highlight direct indices is to talk about their two key use cases. And in my experience, there's really two popular ways that direct indices can be used. And the first is if you are, you would come to me and say, Stu, we'd like to create a tax-efficient index that tracks the S&P 500. We would set up the index by roughly 150 stocks, and then we would engage in aggressively over the course of the portfolio's life, look for loss harvesting opportunities. And loss harvesting can seem a little bit counterintuitive when you're working with investments. I think when I first started studying these strategies, I was thinking, well, why would you want to identify tax losses in a portfolio? Aren't you trying to pick the winners? And let's have those winners. Those are the ones that we want to focus on, not the losers. And it's a great question. And we'll talk about that here in the next few slides. So this is an example of a portfolio, just a hypothetical example of a portfolio with no tax management. And hypothetical value of 100,000, and say at the end of year one, you have a 20,000 gain, ending value is 120,000. The value after liquidation and after paying your taxes, withdrawing a little bit, we're using estimated tax rates here, and that portfolio value would be 112,000. So you're taking a tax hit. You have to pay those taxes on those gains. And highlighting ETFs, I think really drives home this point of not having tax management on a portfolio, because as we talked about, within an ETF, you can't tax loss harvest the underlying positions. So this is a Russell 3000 ETF, and these are calendar year returns here. So say in 2019, if you owned the Russell 3000 ETF, your pre-tax return at the end of that year would have been 31%. So a pretty good return for owning the Russell 3000 in that year of 2019. And if you would own the ETF, you would have walked away with that 31% return. You would have had to pay your tax on that 31%. And you might have been in the neighborhood of maybe an after-tax return of 26 or maybe 25%. Now, the reason that we like direct indices is that you own the underlying position. And if you owned that direct index during that year, roughly 2/3 of the index was positive at 2,237 securities. 1/3 of the index was actually negative that year. So if you would have had a direct index, you would have had a pre-tax return of 31%, but we also would have had the ability to tax loss harvest many of those positions at 795. So that can create not only a great pre-tax return, but it can also create some tax efficiency along the way. And that's what this graph highlights here. So if we use the same scenario of a $100,000 portfolio, we have a $20,000 gain, so pretty good year. If we tax loss harvested the portfolio and hypothetically create 20,000 in losses, our ending value would have been 120,000, but those tax losses would have offset that gain to allow us to keep more in the portfolio. And that is really the secret sauce or the reason that direct indices can make a lot of sense for investors. And it's based on the IRS rule around losses and tax loss harvesting, and that you are allowed to harvest losses, and those losses can be used to offset a gain either in this portfolio or in another part of your portfolio, which can create what we call tax efficiency and the ability to keep more in your portfolio, help accelerate the growth, or what we call compounding. So that's really the first use case of direct indices, where you use cash to invest in a direct index as a core part of your portfolio to help build wealth, but build wealth faster. And that's a key use case of direct indexing. Now, the second use case that we see a lot of investors today utilizing is what we call tax transitioning. And the reason that we see a lot of investors interested in custom indexing is that after the tremendous performance that we've had over the last decade plus in the equity markets, most of us are sitting on very, very large gains. Maybe you're fortunate to own Apple or maybe NVIDIA. And with the performance in US large growth, say NVIDIA, quadruple your money over the last 3 or 4 years, and you have a lot of money tied up in that specific stock, that can create some headaches and some difficulties around controlling risk with being able to diversify away from that asset, but also diversify away from that asset and do it tax efficiently. And certainly the volatility that we've seen in NVIDIA shares back in the fall, and then recently with China's DeepSeek and the concerns around NVIDIA chips, we've seen a lot of volatility in that position. So direct indices can be used to help with mutual funds, ETFs, or individual stocks. If you're sitting on positions that have large gains, these type of portfolios can be used to help transition out of those positions by using the loss harvesting in the portfolio. So this is a simple comparison that talks about or is trying to illustrate the traditional approach versus a direct indexing optimized approach. And traditional approach with a lot of asset managers or financial advisors, I should say, is that when a client comes to them with a large concentrated stock, say it's a $1 million position in Apple, large piece of a household's high net worth, say the cost basis is $400,000, so there's a $600,000 gain in that position. Oftentimes, the tax hit that would result from selling that Apple stock is so great that the client is not willing to transition out of that position, or it creates difficulties transitioning out of that position because of the large gain that would result. That is creating a lot of concentration risk, having all that net worth tied up in Apple stock. And the traditional approach, working with a lot of financial advisors, is just to hold that to the side and then think about low tax years when we can sell some of that stock and move into what's illustrated here, which is a direct or diversified portfolio. Now, the big advantage of a direct index or optimized approach is that because you own these stocks in your own personalized index, you can bring in stocks from other places, other parts of your financial experience or financial life, and actually put those into the direct index. And then as we loss harvest, instead of paying out excess losses, we can use these losses to chip away at the concentrated stock and do that very tax efficiently and create a scenario where we don't create a gain, but at the same time, we're moving out of that stock into a diversified index. And in a nutshell, that's what tax transitioning is. It's simply moving from concentrated assets, whether those are mutual funds, ETFs, or stocks, and moving those into a diversified, low-cost index. And because where we're at, we're up about 200% from COVID today, just for the S&P 500. Valuations in stocks are reaching really almost bubble levels. The last time we've seen valuations on the S&P 500 like this, it was back in 2007 and also 1999 during the tech and telecom bubble. We're reaching levels that diversification is very important in investment portfolios. And I think investors realize that, and with a lot of their concentration, looking for vehicles that can be able to help diversify their assets. Okay, so last couple of thoughts. I mentioned that a direct index is a personalized portfolio. It's like your own index that has been created for you. And because you have a lot of control, that creates a lot of capabilities over your own index. So if you're thinking in terms of maybe avoiding certain areas of the market, you have that control as opposed to an ETF or mutual fund. Or perhaps you would really like to focus on some interesting parts of the market that maybe from a valuation standpoint are more appealing than, say, large U.S. growth. You can target a value index. You can target a dividend-producing index. You can restrict certain sectors or certain industries. All of that capability is available to you to create your own personalized, customized index. So looks like we're at roughly around 27 past the hour here. So just in summary, really two kind of key use cases for direct indices. If you're going to be facing a large tax event, or if you're in a high tax bracket today, the cash-funded, tax-less harvesting direct index option makes a tremendous amount of sense to help you save your hard-earned money as opposed to writing a check to the IRS. And then secondly, if you are struggling with assets that are large gains today, these can be a very, very powerful tool to help you transition out of those assets, diversify, and do it at hopefully a very low gain, if not zero. As a portfolio consultant, that's generally what I try to focus on when I'm building portfolios for clients, and usually pretty successful. There's some securities that are just extremely large gains. We have to get a little bit creative, but would love to lend my experience through the Savvy team to help you create tax efficiency in your portfolio. So with that, Ashley, I'll turn it back to you. And I think you have some questions that have come in, so happy to hit on those.
Awesome. Thank you, Stu. That was a really great presentation about, and thanks for sharing all your valuable insights on direct indexing. It's really helpful when we're able to see different stories about how it can be applied and that it's custom to everybody who's using it. Our audience does have some great questions. And if you haven't had a chance to submit any questions, it's not too late. We're here to help. So our first question, it looks like, is, what type of profile would this be ideal? This would be for a strategy.
Great question, Ashley. So the value through creating tax losses in a portfolio are heightened the higher you are in the U.S. federal tax brackets and state tax brackets. So, for example, I live in California. I think we all know really the three states that are highest kind of tax brackets are going to be New York, New Jersey, and California. So the highest Fed rate is 20%. You add in the net investment income tax, that puts your gains at 23.8. And then you add in a California rate of 7 to 8% on top of that. Very quickly, for capital gains, you're looking at almost ordinary income rates on realizing or selling securities in your portfolios. So the higher you are in the tax brackets, the more value and tax alpha can be created in a portfolio. So that would be a consideration. So are you in the higher Fed rates or are you in a high tax state? That makes a big difference in kind of the value that's derived from these strategies. If you're in a low tax bracket, the tax loss harvesting, or say even a qualified account, there's certain reasons to use direct indexing qualified accounts, such as the customization. But really a big part of the value of these strategies is the tax loss harvesting and tax deferral abilities through tax transitioning.
That makes a lot of sense. Our next question is, what type of indexes can you target?
Great. So we have roughly around 35 to 40 different indices that you can target, everything from large cap core to, say, a global strategy that uses international, or some factor portfolios, as I mentioned earlier, where you can target, say, dividends or large cap value. We also have some thematic portfolios that target like cybersecurity. We're actually working on also an artificial intelligence portfolio right now that's not quite ready, but would that should be available, I'm guessing, probably by the end of the year. We also have some interesting factor portfolios that focus on momentum. So if targeting one of those indices sounds interesting to you, I'd encourage you to reach out to your savvy investment professional.
Yeah, definitely. Your advisor can always help you find the right one for you. So definitely reach out and they can walk you through some of your options. And then could you maybe provide an example of tax transitioning?
Sure. So experience recently, I run usually around 10 to 12 tax transitions a week, usually. So I had an example of a couple different examples this week that I think are very helpful in understanding how tax transitioning works. One was a portfolio of roughly around 10 stocks that the client owned and has owned for many, many years. And they were the kind of the usual suspects: Apple, owned some Amazon, and a few other stocks. And the client owned those, but they were all at significant gains, and they existed in a taxable account. We were able to design a nice transition where we took those 10 stocks, put them into the portfolio, added a little bit of cash to build the index around those positions, and created a Russell 1000 core index with those 10 concentrated stocks. And now, as the year goes on, we'll look for loss harvesting opportunities where we can chip away at those concentrated stocks, not create a gain for the client, and help away from those stocks and diversify their portfolio. So a great way to get a kind of plan around controlling risk with those existing stocks.
Awesome. Thank you for sharing that example. I think those are all of our questions for today. So thank you so much, Stu, for joining us and sharing your insights. And we're going to be sharing the recording for this webinar in the coming weeks. And I'm really excited about all of this and how this can be applied for investors out there and what they can learn about direct indexing as you deep dive with your different advisors. Just let us know if you have any additional questions, or please follow up with your advisors. Otherwise, thank you so much for joining us today. Stu, if you don't mind moving to the disclosures for purposes of compliance, we just have to host those for the last couple of minutes. But thank you so much for joining us today. And thank you, Stu, for presenting. We really appreciate you joining us. I hope everyone has a great day.
Alrighty. Bye-bye, everybody.
Bye.